When you're investing into real estate, one of the fastest ways to scale is to enter into a new market. The problem is that a lot of operators go into a new market, but then they crash and burn. So, John and I, we're going to be breaking down today the major mistakes that operators make when they go into new markets. Now, if you are interested in investing in real estate and it's hard to find great deals and you don't have the time to go into new markets and do all this research, go to fulloutinvesting.com and you're going to find out a little bit more about our 10-step full out investing process. There's a sample deal there as well. It might just be a really good opportunity to come in, partner with us, and to be able to get really strong returns to help you hit your goals faster. Go to fulloutinvesting.com. Hey, John, it's great to be here with you.
It's good to be here, Mark. Thinking back to my days at my prior company, Mark Spain Real Estate, we expanded into new markets beyond our original market of Atlanta. And so part of that, we did a lot of research, like how have other companies grown and scaled? And what we actually quickly found was Walmart as a prime example, where they did what they called the ink splot model. So it was like this idea, you have this, foothold in Arkansas where they originally formed. And so if you put some ink and dropped it on paper, it expands out, right? So like, where can the trucks distribute easily, right? And then it's like, okay, now you can put another ink spot over here and connect your distribution hubs. And so how we started was close, right? Where can we drive? If there was some sort of emergency and I needed to hop in a car and be in, that market, could I drive there in a reasonable amount of time? So Charlotte was 3.5 hours. That was our first market. And so over time, we got the confidence to then, go to Texas, right? Which required more of a plane trip. So that's really how we've approached it here at Faris Capital, starting in Florida, where you spend half of your year, markets that we were all highly familiar with. I went to school in Florida, right? And then we looked in Charleston, an area that's close to Atlanta. So it's easy for me to get to, right? And so it's interesting because now we're looking at some of these markets that maybe are a little further out of reach, but you start close to home is, at least in my experience, what really works well. And then obviously we're going to get into the mechanics of these types of deals and the things specifically in each market that you need to be looking for before scaling or making a decision. So excited to dive into this topic today.
Yeah, and John, you know the story as well that me investing just north of Toronto, it used to be a really great market,
Yeah.
and so sometimes you're actually forced to go into a new market when you realize, hey, listen, there isn't the same play. The properties aren't cash flowing, so they're not making more income than the expenses anymore. They used to, but these emerging markets can change pretty quick, and so if you were in an emerging market and you're not anymore, it's really important to identify that. But then, you come into this whole thing if you're really busy and you don't have time to actually go and drive to a new market and do all the market research as well. That's where you get stuck. And that's where actually in Ontario right now, John, there's a lot of investors that were used to being in a high emerging market with high growth and cash flowing properties, and then it's just changed fundamentally. And so sometimes you're in an emerging market, you're blessed, and then other times it's like you got to start looking outside the area, and then that gets you into new challenges as to how do you do the market research, how do you operate these, what are the cross border, potentially cross border interstate potential changes there as well, which it creates a little bit more complexity. But we're going to be breaking down, if you are looking at a new market, some of the major things to watch out for in this conversation today. And just to think about, why somebody would be going into a new market as well is what we're going to be jumping into.
That's right. The appeal of new markets is obviously there, right? That diversification, the potential for new opportunity, and even just maybe finding better deals, right? But it is definitely a process you want to go slowly with and make sure you're making the right decision. You nailed it. I mean, even across state lines, there's different rules and regulations and even potentially trends, right? Things that work in Atlanta may not work out so well in Tampa, maybe a certain type of amenity. So it's definitely a process that when we're thinking about a new market, we spend a lot of focused effort and energy and time, almost most importantly, before we dive in. The margin for error is very small in these deals, right? So you have to really make sure you're not learning on the fly, right? Doing your due diligence, doing your research before entering these new markets is definitely top. So in terms of those biggest mistakes that we've seen new operators make, is they kind of skip the deep market research, right? Maybe they get a deal sent to them, and that happens to us all the time. I mean, we're, for example, tied in with these, large nationwide brokerages. We have great relationships. So, our Atlanta broker may call us and say, hey, one of my partners just listed a deal in Louisville, Kentucky, and on paper it looks great. But you're like,
Yeah.
do we really understand that market? Do we really understand the market and how the submarkets within that market are performing and the demand drivers? So it's not to say we don't look at that opportunity, but we're definitely slower with that type of opportunity because that deep market research is so critical. And really what I'm saying is actually getting boots on the ground, like driving the area, spending time touring assets, right? So a lot of that can be done online, but nothing beats the boots on the ground approach. So talking to local property managers, contractors, other operators in that market, going online, looking to see how the market's performing, whether through research platforms like CoStar or just looking at economic news, right? The business journals and things like that. So that deep market research is so critical. And understanding the regulatory environment, like what are the eviction timelines, like how long does it take to get a permit if we need to pull one, are there rent control laws in place? Now it's interesting, Mark, because we often focus on these states that tend to be more Republican led, which generally means we'll have less things like rent control, but you even sometimes see those within a municipality, right? So the city may have some rent control. So it's definitely something you want to take a lot of time with and do that deep research before making any fast decisions.
For sure. And when we say rent control, as in what that means for if you're new and you're not really sure what that means, that just means that you can actually raise rents to market value without any sort of restrictions on your rent renewal rates. Um, but John, going back to like, for example, the 2.5% there is a rent control in, say, Ontario, but say in Florida, for example, you can raise rents to market value and there's no restriction. So that's what we mean by rent control. Now, uh, going back to skipping the market research, John, this you can imagine like you're looking for a good deal and you build a relationship with the broker, and then they send you a deal. He's like, "This is a killer deal. Take a look at it." You can imagine that how easy that would be to skip the market research because the deal looks really good, right? Like it
Yeah.
just makes sense. It's like the deal comes in, you see it, it's like, oh, that pencils out, that looks really good, but you didn't actually slow down to see is the area a good area to invest in? Is employment growing? Is it shrinking? Do you have a lot of competition or new deliveries that are going to be hitting the market soon that you're going to be competing against? As taxes, strong or not, as in like low taxes where, people are moving into an area for, is there population growth? Is it growing faster or slower than the average growth in an area? Is there a manufacturing plant that houses thousands of jobs close by? Are they shutting down, or is there a new one coming? Like, is there rent control in this area or not? Like, is this in a flood zone or not? Like, this is where like the reality is, it's like, yeah, we did our market research, but when the deal's in front of you and you have to move quick on it, that for operators is such an easy slip because there's so much pressure on you to move quickly on it, and the numbers can be perfect, but you miss the bigger picture here. And this is why it's so important that you do it up front. You do your due diligence up front in an area and you get very clear on the pockets. So when the deal does come in, you don't need to do all that after. You can move quickly on it because you've already pre-vetted
Mhm.
an area. This is massive. This is so important that you do your market research before than after, because you just don't have time. You don't have
Right.
time for it. And I mean, we've seen this, John, where you get into an asset and a large new competitor moves next door. It affects your projected rents of what you're getting. Now you're competing where maybe they're bringing down their new asset where they would be charging normally $2,500 a month. They might be charging like 1,800 for to try and lease it up fast, or they might be offering some concessions, a 3 months rent where they're super competitive, and that is going to affect your any of your rental rates that you're having because it's brand new product
Yeah.
as well. So doing your research up front will allow you to move quick when an asset actually comes through you. This is so important and so easy to miss. That's why I just really want to underline that, because it's one thing to say, yeah, but when the deal's in front of you and you've been waiting for a while and the broker sends it, I'll tell you, there's a lot of pressure and it's an easy one to miss.
That's exactly right. And it, to your point, it is so complex because it's not just the asset, right? It's what's happening in the area. And I mentioned the boots on the ground thing, but sometimes you'll never know if there's a potential for a new building down the street until you drive the area and see a big plot of land with a for sale sign on it, right?
Well, and
Zone
John,
residential.
100%. And what
Yeah.
I've realized from Canada to the US, the big difference that I notice is it's way more polarizing. You get certain neighborhoods that are, really nice, and right across the street there's another neighborhood that you want to stay away from. Like we
Mhm.
look at crime rates. That's another thing, like looking at crime rates before you start getting into an area. And so there's a big divide, more
Yeah.
so there's a bigger divide between the rich and the poor in certain neighborhoods to stay in and don't stay in. So the broker could be sending you comps for an area, comparable properties for sale and that have sold and whatnot. And unless you know the area really well, you could easily start comparing properties where local people are like, no, I would never move there. And then all of a sudden you have a multi-million dollar asset. I've had, John, I don't know how many different operators that, especially from Canada moving down to the US, they start looking and they realize, geez, like there's just so many different like neighborhoods, and I got to fly down there to take a look at these, and I just don't have the time to do it. And the reality is having somebody boots on the ground and having a professional where this is their full-time job and that's what they've been doing, it gives our investors, really, at the end of the day, and any other operators that are doing it at that high level, a major competitive advantage when the deals come up that you've already pre-vetted and you've already selected areas that are really great and areas that we want to stay away from. And we can move a lot quicker on deals, which actually helps us get more deals in the long run because brokers know we're not hemming and hawing on
Yeah.
an asset.
No, and it's a very involved process. So just to give you a little peek at what Faris Capital Partners does is when we're contemplating a new area, say for example, when we decided to look at Metro Atlanta probably has a few hundred submarkets, right? So you don't just go, oh, we want to buy a deal in Metro Atlanta. What we do is we actually go in and we do a
Yeah.
research project where we look at every submarket and we go through, we have like graphs and charts and we're
Yeah.
tracking all the different metrics. So things like the average, income in the area, the average age, the percentage of renters, population growth. I can kind of keep going, but we have this giant spreadsheet. And then what we do is we use conditional formatting, right? So if something's over a certain amount that's important, then it's green. If it's at, it's yellow. If it's below, it's red. So we can quickly look as we do this research and say, okay, these are the submarkets that we really need to focus in on. You nailed it. Atlanta is actually such a great example, particularly when you get inside the actual city of Atlanta, which is not really an area we target. And this is kind of why, but quite literally, street to street can make a massive difference, right? Some of these in-town neighborhoods. And so, high crime, you can throw a football and hit a high crime area. And then on the other side where you're standing is like perfectly safe, right? And so it's a real factor. And so understanding those dynamics is so critical to make a good decision. So, we are exploring new markets now, but it'll likely take us 3 to 4 months to complete the needed research before we really start leaning into source deals.
Yeah, 100%. So, John, we had one of our really strong investors. They actually, when I say strong investors, so one of the bigger players that come in and invest with us, they actually, Atlanta was one of the markets we had an opportunity and have an opportunity. Actually, now we're actually close to getting this filled. And he said to me, he's like, listen, I went to a conference there in the past and I'm just not a big fan of Atlanta. And then,
Yeah.
I started asking him, okay, share a little bit more about it. He's like, when I went through it, I wasn't getting a good vibe from it. And that was a perfect example of going through certain area that we would never invest in.
Right.
But if you actually go out this way and out that way and out that way, when you point to different directions, there's really nice areas that you would go to.
Yeah, that's
And
right.
so that, like, the 100 plus sub markets, like this is so important to know. It's like there's certain markets. I mean, Tampa, Charleston, Atlanta, these are big markets that we love. There's certain pockets, if you were to drive through, we totally agree. We would
Yeah.
never invest in that area at all. But
Yeah.
there's really good markets that we would stay in, but the overall story is really strong. Like Noonan, for example, you got 2,000 manufacturing. Yamaha is like right there, 2,000 plant, 2,000 employees close by. You get 1,200 employees at the hospital right there. You got 500 at Amazon, and it's all within minutes drive. These are
Yeah.
high paying jobs, and the community is really nice as well. But like you had mentioned, Metro Atlanta, there's certain areas there that we would never go close to as well. So this is like a really good example of not throwing a blanket over where, yeah, I more so like if you're in Ontario in Canada, there's certain areas like cities, we'll call them secondary cities, where it's like it's pretty much all the same. You don't get these same kind of sub markets as polarizing as you do in the U.S.
Well, and it's funny when you shared that story with me about that investor, I assumed that it's like the conference must have been at the Atlanta Convention Center because it's like right downtown. Nobody
Yeah.
in Atlanta goes downtown. Like you don't go downtown unless you're going to the courthouse or like, it's like there's a couple banks down there, but it's like Midtown or Buckhead. When I think of downtown Atlanta, I'm really saying Midtown or Buckhead, right? So it's like I knew in my mind it was like, oh, it's probably at the convention center. Nobody
Right.
told him to move down to get a hotel in Midtown, and so he booked one right there, and he was like, where the hell am
Yeah. Yeah.
I? So
Exactly.
yeah, it's an interesting city in that way, but it goes back to exactly what you said. It's really down to the neighborhood and then down to the specific submarket. But then what are the overall demand drivers of the area? And so Noonan's such a great example. You nailed it. There's so many job opportunities right within there. You're also 30 minutes to all those major employment centers in
Yeah.
Midtown, Buckhead, downtown
Beautiful.
Atlanta, airport 20 minutes away, 25 minutes away.
Yeah.
So kind of back to this, and I kind of touched on some of this, but the local laws and regulations, it's almost like the market, like 1.5, right? In terms of the things you need to
Mm.
make, be aware of before you make a bad decision. But, getting with a local attorney and really understanding what's going on in that area. And, beyond that, like, is there anything on the table, right? Because sometimes things might be proposed and they just haven't passed yet. And so if you're not aware that, hey, there's actually some movement in, say, for example, the local city to enact some rent control regulations or something like that, may not be there today, but might be in 2 years. So what is the current economic climate? What's being proposed? What's being discussed? And so when you get that on the ground intelligence for somebody who lives in that area, knows that area well, and is paying attention to, sort of what's on the docket with the city council or what's happening at the state level that could impact the viability of this investment going forward. So, that's where we lean into our vendors. We even ask, we have a securities attorney that we work with, but who do you know in that area that we should talk to? What contractors we should talk to? We talk to our property management company. One of the benefits we have as property management company we work with Asset Living is nationwide. So our team is focused on the Southeast and the areas that we specifically invest in, but certainly they could reach out to a colleague and put us in touch with somebody who's very familiar with that market. Because, once again, if you just don't understand the eviction timelines, a great example, South Carolina makes it very easy to evict. But locally within the Charleston market, the judges tend to be a little more forgiving. And by that, I mean, they would rather say in put together a payment plan for the resident who's behind. Now, the good news is if they miss one payment plan, payment, the eviction happens, but they're likely to go that approach. So we know that. And so we have to factor that in when somebody's non-paying. So often what we'll do is we'll propose the payment plan. And if they can't meet that, then we process the eviction so we can show the judge, hey, we tried, right? So, but understanding that makes a big difference. Otherwise, you might be waiting 3 months just to find out you got to put this person on a payment plan. So
Mm.
knowing that, we proactively put that in place. So this goes back to it's hyper local. It's not just necessarily the state. Sometimes it can even be an area within a city, right? We speak about Charleston, but we're also in Monk's Corner. We're in Goose Creek. These are actual cities within that area that could have even like local regulations, right? And what is the sort of mood, if you will, of the city council? Are they favorable to growth? Are they unfavorable to growth? What kind of things are they proposing? I'll use Monk's Corner as a great example. One of the things we loved is when we were looking at that deal, we were going onto their website, their economic development website. We called and we learned that they were planning to redevelop downtown Monk's Corner and create like a restaurant, like cultural hub, with center, shopping and all this stuff. It's like, great, that'll attract more people, right? But sometimes you go into a city and it's like the NIMBY, not my backyard kind of crowd, and they don't want to build that stuff. For example, where I live, there's a city just, one city over called Johns Creek. Lovely place, but they don't want sidewalks. They don't want to spend any money on certain things. And so that's an area we may avoid because our residents rely on certain things like that. So it's definitely by the way, it can be a lot of fun doing this research and finding those little honey holes or those little pockets, right? So that's, if you treat it like that, this is actually going to take a lot of effort and attention, but we're going to identify some key pockets. And by putting in that work, ideally, that gives us a bit of an edge over those operators that are less willing to do that deep research.
100%, John. And this is where majority of our investors, what we find is that they've invested in one or two properties in the past and they've looked after it themselves. But now that, you know, many of the investors, their markets that they're in, they're not emerging anymore.
Mm-hmm.
The numbers just don't pencil out in their market. They're so busy. With the thought of doing all that market research is like, they might start, but it's very, very rare that they can manage doing both long term because things change as well. Even for myself, like unless you're doing it full time, like we have Joe that he's been doing it for the last decade, and then you're doing it full time with Joe as well, and we're bringing on like a full time another team member as well to be able to help. Going and do this market research. This is not like a part time thing if you want to
Mm-hmm.
do it right, because you said it exactly. It's like you find these little honey holes. Like we're like detectives.
Yeah.
John, it's like you find these little spots that nobody else can find, right? Or very few people have found, and you're able to go in and maybe you can pay a little bit. You go a little bit more on it because you have certain data points that the competitors don't have, right? And I think that's where, or maybe you don't offer as much as somebody else because we're factoring in something that they didn't factor in
Yeah.
as well. And so that's actually been very helpful for us as well, John. And when we're negotiating deals with the brokers, is that we're creating our case as to why, and here's everything we're factoring in. And we're factoring this in because, when we do our inspection, this isn't going to be something that's going to come up down the road. For us, we're factoring that into our price right now. And the other operator perhaps is not even talking about that with that broker. Well, that broker knows like, okay, there's going to be less headaches with us, whereas with these other operators making this, maybe even going a little bit higher on their offer, they're not factoring this and this in. And
Yeah.
so that actually gives the brokers as well way more peace of mind that there's going to be less potential risk of fallout in a deal, which is
That's
the
right.
last thing that they want.
Well, and I think Georgetown was such a good example of that, where the broker shared with us there were two offers that were 300,000 or more higher than our offer, but they selected ours because in our cover letter, when we send over our LOI, we've actually done a podcast on this, but we include a cover letter outlining, we have our financing lined up with this lender. Here's their contact information. We have the insurance with this broker. Here's their contact information. But we also highlight that we've personally toured all the rent comps. Like we've driven the market, we've stayed in the market, we understand the dynamics in that market. And so that broker goes back to the seller and says, hey, look, I recognize the other offers are higher,
Yeah.
but this is a better offer. Here's why. They've already done XYZ.
Yeah.
And sure enough, we got awarded the offer. We're closing in the coming days. I mean, this podcast episode might air after we close, but we're closing here at the last week of August. And we were hundreds of thousands of dollars less than the other two offers, right? And so that just speaks to the broker, right? And understanding that we've done our research, we've done our due diligence, we put the effort in, and they're more likely to take that offer given those data points. So I think another thing kind of at that local level that some operators miss is they don't really focus or learn or understand the local resident expectations, right? And so, for example, maybe we renovate units in a way that is not, to the current like standards in that area. I mean, largely when we select our renovation kits, we work with a designer and we're picking things that are on trend, but not trendy, if that makes sense. So in other words, something that's still going to look good in 5 or 7 years. So we don't try to get like the most trendy stuff, but something that just looks really good, feels new, feels modern, but will stand the test of time. But amenities are really kind of an important factor. So for example, right now we're focused on the Sun Belt, but let's just say we start looking at the Midwest and we go, oh, let's build this beautiful outdoor, play area or whatever. But 70% of the year it's going to be covered in snow, right? So maybe we should focus more on some interior, amenities.
You're talking about north of Toronto right now, John. 70% of the year
Yeah, that's right.
with snow. Short
Yeah, I think
season.
Shristi, our marketing director, was the one who told me, he's like, "We have 2 seasons here, John. Winter's like 8 months, and we have summer for
Yeah.
like 4," right?
Yeah.
But,
Well, and
yeah,
then Barrie, north of Toronto, we got a couple of snow belts that you even go a little bit further. So,
yeah,
or
yeah.
a little less, even
But
less in the summer.
understanding that, like, what
Yeah.
is in the area, and that goes
Yeah.
back to why we toured the rent comps. There's so many reasons we toured the rent comp, but one is to see what are the other apartments offering, and then we asked the property manager, "Oh, is this well used? Do people like this? Like, what's one amenity people say they wish they had?" Right? And because we go in and tell them it's market research, we try not to take up too much of their time, and we try to be pleasant, nice, and professional. They'll open up and start sharing. I mean, we learn a lot, right? For example, we see some operators where they'll line item 20 different things. So your rent's 1,500, but we're going to charge you $5 for this, $10 for that, $20 for this. And we'll ask, well, how do residents like that? Oh, they hate it. All right, well, we're not going to do that. We're just going to, do a headline rent, right? So a lot of great data and research we get from those tours, but the amenities are a big part of it. And there's been times where we walked out of an amenity and said, "Oh, we're doing that exact same thing at our pool. Like we're gonna just basically steal that," but it looks so good, and you see 25 people out enjoying it, and you're like, okay, that's in demand. So really understanding those local resident expectations is so critical. Talking to those leasing agents, talking to the residents that you might walk into in the parking lot, find out what's on their mind, what things they look for. And of course, when we're touring the asset we're thinking of acquiring, we try to talk to as many residents that we see out in the parking
Mm,
lot or in the unit, just asking them, "Hey, what do you like about this place? What do you wish it had?" And then leveraging that to make those decisions.
for sure. The next is rent growth. So we'll just say having unrealistic rent growth projection when you're doing your underwriting. And so this is where it's very, very easy to say, oh, the market, if it's appreciated at like 5%, I'm putting 5%. But the reality there is that you want to be very conservative, and you want to look at history, and you want to look at the overall market, and you want to look at forward looking projections with the right data. And though, so John, this is where for us, the average person wouldn't have access to CoStar. And
Right.
so CoStar is something that we spend tens of thousands of dollars on every year just to get access. So it's CoStar is it's a system that commercial brokers, this is what they use for data down to be able to down in US and Canada on the commercial side. So on there it has future facing market data points, so new deliveries, new permits in an area. It's got, I mean, it's just the list goes on and on and on. So for us, we use that data to be able to make forward facing projections in a very conservative way. So, for example, if a market is projected to grow over the next 5 years at say 4% a year, we would put in like 3.5% is
Hmm.
what our annual rental growth would be. And that's not even including any sort of like forced appreciation would be in addition. But if the overall market we think is going to do four, is what all these analysts, hundreds of analysts are actually projecting. We get that data, we pay for that data, and then we're more conservative to that data. Whereas majority of operators just wouldn't see that. And so when you have data as well, it not only that helps with your overall decision making, but definitely with rent growth, that's one of your highest levers when you're doing your underwriting that you can be too aggressive on, and that can really throw out your numbers. And doing the research ahead of time, you're able to really identify certain markets where the numbers and projected increases are higher because we've tracked the number of new deliveries coming to that market segment there, to that certain area, and we know that there's incoming employment coming to an area. There's very low new inventory that's going to be delivered to that market, and we know that increasing population. The data has told us all those points are going to come to a crossroads, and that's what's actually going to help us make better projections in regards to what a market can actually do. And having the right data helps us do that, which is very, very important.
That's right. And the last mistake new operators make is they don't choose the right partners.
Big one, huge
Yeah,
one. That's
such a
is huge.
absolutely. So for us, I mentioned we work with Asset Living. They're a nationwide company. So leveraging, a company with a proven track record of success in that market, from the property manager all the way to your contractors. And we've even found this with contractors where sometimes, we're in this area, we're happy to travel to that area. And what ended up happening when we did that is, we found out that it was taking longer to get things done. They couldn't get their crews there, it was maybe a little bit further. And so at the end of the day, we made that decision. We only work with contractors that have a local presence in that market with that proven track record. So, vetting these partners, right? So don't, just pick up the phone book or Google search, right? Vet them through references, looking at their past projects, like getting their reputation checked through local sources, those references going back to those. So critically important. And I already mentioned, a local attorney that understands the rules and regulations and the kind of things that are on the docket are being proposed in that area so that you can make those smart decisions looking 5 years into the future. Because at the end of the day, these are 5-year holds. And so a lot can happen in 5 years. So somebody who has that on the ground knowledge and experience is very important.
Yeah, that's a huge one, and same with the on the GC side as well.
Yeah. Yeah.
It's like, yeah, I'll go fly down there and do that, and I'll look after all the renovations as well. Don't worry, I'll look after you on that. It's like boots on the ground is really, really important. And then when you're going into a market, this infrastructure, or we call them like the power players, that you want to make sure that you have your power team ready to go when the deal comes. You cannot be formulating that after the fact, because then you're rushing to get the right people together, and that's where you make mistakes when you're rushing versus like being very selective ahead of time. Then you can, it's kind of like you go slow to go fast at the
Yeah.
beginning, you go slow to go fast, and this is where a lot of operators will miss on that. And listen, when you are doing a turnaround, like a lot of people, a lot of operators, when they're buying and or investors when they're buying a new market, they might buy one property with like 1 or 2 units. When you're doing a renovation and there's no income coming in, this is where a lot of operators get hurt. So,
Mm-hmm.
for example, John, as you know, like we were buying properties that have, say, 100 units. When we're doing renovations, we might be doing 2 or 3 at a time, or 3 or 4 even, or maybe more, maybe 5 or 6. But the reality there is that if somebody just picks up and walks out, we still have income coming in. If you're buying a property with, say, 1 or 2 units, and you have you have zero income coming in, and the GC gets up and walks out, or he doesn't, he stops working, or he's slow, or he rips you off in regards to the renovations you paid him up front, and he walked out on you. What happens now? Well, you have zero income coming in, and you got most of your budget's already out the door. Whereas with us, we do like maybe max like 5% at a time of the overall renovation budget is what we're doing. And they need to prove themselves. They need to finish it within 30 days. And because you're doing larger assets, that they're actually wanting to do a better job. But when you do these 1 or 2 jobs, it's easy to rip you off as an out of towner. And so this is where like making sure you get the right partners, like the GC is one example of that, and property management, but doing that up front is so I can't underestimate or overestimate how important that is for anybody that's jumping into a new market. And so this is where we really encourage our investors. It's like if you're running if you're running a business and it's going really well, you really need to. And we're going to be doing a podcast on this one soon, because I'm really excited to break down, figure out what you're worth per hour in your business. And if you're going to have to do all this work that we talked about, all this vetting with that much risk of things that could potentially come up, factor in how much you're worth per hour, and actually work that into your overall returns. And when you do that, because most of our investors are all high net worth, they're running successful businesses, they realize, holy geez, the return that I thought I was going to get is actually not even anywhere close to what it's like working with you guys. Because you guys look after all the work, you guys have all the competitive advantages, like the CoStar access, the full-time team members that have decades of experience doing this full time. You have a full team doing this full time. And they get, as an investor, investors get to keep the majority of the upside in these deals. They come on as a full equity partner. It's not like a JV where you're doing 50-50. These are larger deals. So majority of the upside actually goes to our investor partners. All of the above, they realize, holy geez, this is actually better.
Yeah.
This is better. I am getting higher returns. I can actually make more money with less risk. And that was like a big paradigm shift that I had to overcome at the beginning. It's like, I need to do everything on my own to make my own to make more profit. And I realized actually, because John and you and I invest on the limited partnership side, on our investor side as well. We go into every one of our deals. So we built this essentially for us to invest in
That's right.
the same returns that our investors get. Obviously, there's the business side. I couldn't find what we actually built, John. I couldn't find it. And so that's where you came, we partnered up and we built it. But I'll just say, like, there's way more risk and there's way more upside actually coming in and putting our heads together to be able to get a win-win-win opportunity and lower your risk in a big way.
No, 100%. Looking forward to that podcast. That'll be a fun
Yeah, that's a
one.
good
But
one. Yeah,
yeah,
your
yeah,
idea on
that's
that
right.
one.
So, just really quick to recap, how are we approaching new market selection at Faris Capital? So, we start really at the top end. So, we're looking at migration trends. So, we leverage data sources like U-Haul, for example. They publish a report on an annual basis. Where are the most one-way truck rentals headed? The United States Postal Service publishes a report on address changes. Then we can look at census data to see where population growth is trending. Job growth is obviously important. So once we identify markets, looking into the specifics of that market. So are there jobs coming to that area, and is it diverse economic employment opportunities? In other words, not just one or two industries. The affordability ratios, we've talked a lot about that on previous podcasts, but the rent to income ratio is a critical one. So can people afford the rent that we're trying to target here? And then things like the landlord laws. And then getting down to the ground level, building those relationships with local property managers, attorneys, contractors, vendors, getting insights from them, and then testing those assumptions on the ground site visits where we actually drive the area, learn all about it, tour rent comps, go to local restaurants, drive the property at night, all those things, and check those boxes. And just never compromising on our vendor quality, right? The right team means smooth execution. So critical that we get the right people on the bus, so to speak. So that's how we're approaching new market selection. Right now, we're focused on a few key markets, but we're looking to expand into new markets. So we'll hopefully have some deals to share with the listeners here in the coming months in some exciting new areas with great upside potential.
Yeah, John, this was a really good one. It's a really good one because more and more markets are more and more unaffordable.
That's right.
And there's more and more reason to go into a new market. It's really, really important to not have to learn the lesson by not getting it right.
That's right.
It's really important because, when you do that, it's just one of those things in many cases, John, I've seen when they don't get it right, it gets them completely out of real estate, which is such a shame because real estate, I mean, it's made more millionaires than any other asset class. Like, it's a beautiful investment, but it hurts when you get it wrong. It hurts in a big way.
Yeah.
And, nothing is worse than, you work your whole life and then you get stung in a big way that, knocks you back a decade for all the work that you put into it. So we talk about this a lot. You can't get these deals wrong. You can't get them wrong. You have to get them right. And so this is where you got to build. That's why what we've done, John, is we've built a machine of highly talented experts so that our investor partners, when they come in, they're coming in and they we're protecting the downside by doing all this work, and we're hedging the upside in their favor by doing all these things that give them a competitive advantage in the best markets and in the best submarkets in the best neighborhoods as well. So if you do have any questions or you want to learn a little bit more about us, definitely keep on listening to the podcast. You can share it with any other high net worth investors that you think would benefit from it. You can go to fulloutinvesting.com as well, where you'll see our 10-step full out investing process as well. You can check out our 28-day full out transformation system is actually on there as well by going and watching that video. It's about 15 minutes. You can speed it up, but you're going to get a lot from that. Go to fulloutinvesting.com. So thanks again for listening, guys. If you enjoyed the show, you can go ahead and subscribe. We love and believe in you guys. Keep investing and dreaming big.